If you've spent even 5 minutes looking into forex trading, you've already heard the word pip, and if you're like most beginners, you nodded along and pretended you knew what it meant. So let's actually sort this out properly, because pips, points, ticks, units, lots, these terms get thrown around constantly, and nobody really stops to explain them clearly. By the end of this video, you'll know exactly what each one means and how they all connect. Let's start with pips. A pip stands for percentage in point, and it's simply the smallest standard price movement in a currency pair. It's the unit of measurement for how much a currency pair has moved. For most currency pairs, your majors like Euro US dollar, Pound US dollar, US dollar yen, a pip is a movement of 0.0001. That's 1 unit in the 4th decimal place. So if Euro US dollar moves from 1.0850 to 1.0851, that's a 1 pip move. If it moves from 1.0850 to 1.0950, that's a 100 pip move. There is one exception worth knowing early. Japanese yen pairs, like USD/JPY, are only quoted to 2 decimal places. So for those pairs, a pip is a movement of 0.01, 1 unit in the 2nd decimal place. Same concept, just a different scale because of how the yen is valued. Now, and this is where people start getting confused, most modern brokers actually quote prices to a 5th decimal place. So you'll see EUR/USD quoted as something like 1.08504. That extra digit at the end is called a pipette, or sometimes a fractional pip. It's just a more precise version of the pip. 5 decimal places on most pairs, 3 on yen pairs. Okay, so that's pips. Now, what about points? Here's where it gets a little murky, because the word point is used differently depending on who you're talking to and what platform you're on. In some contexts, point means the same thing as pip. In others, particularly on platforms like MetaTrader, a point refers to that 5th decimal place, the pipette. So 1 pip equals 10 points on those platforms. This trips people up all the time. If someone says their EA makes 200 points a month, they might mean 20 pips, not 200 pips. Always clarify which definition is being used. It genuinely matters. What about ticks? Ticks are more commonly used when trading indices, commodities, or futures rather than forex. A tick is simply the minimum price movement for that specific instrument. In some markets that's 0.25, in others it's 0.01. The concept is the same as a pip, it's just the language used in different markets. You'll come across it if you ever trade gold, oil, or indices on your platform. Now let's talk about units and lots, because this is where it starts connecting to real money. When you place a trade in forex, you're always trading a certain number of units of the base currency. Units are the raw number of currency you're buying or selling. But because trading in individual units would mean dealing with millions of numbers, the industry bundles them into something called lots. A standard lot is 100,000 units of the base currency, a mini lot is 10,000 units, a micro lot is 1,000 units, and a nano lot, which not all brokers offer, is 100 units. Now here's the bit that actually matters to you as a trader. Lot size determines how much each pip is worth in real money terms. On a standard lot of Euro USD, 1 pip is worth approximately $10. So if you buy 1 standard lot and the price moves 20 pips in your favour, you've made $200. If it moves 20 pips against you, you've lost $200. On a mini lot, 1 pip is worth approximately $1. On a micro lot, 1 pip is worth approximately 10 cents. This is why lot size is one of the most important decisions you make before entering a trade. It's not just about direction, it's about how much each pip movement is actually going to affect your account. Let me bring it all together with a quick example. Say you're trading GBP/USD, the current price is 1.2700. You believe it's going to go up, so you buy 1 mini lot, that's 10,000 units. The price moves up 30 pips to 1.2730. You close the trade. Each pip was worth about $1 on a mini lot, so 30 pips times $1 equals $30 profit. Now imagine you'd traded a standard lot instead. Same 30 pip move, but now each pip is worth $10. That's $300 profit. Same trade, same analysis, just a bigger lot size. And of course, it works exactly the same way in the other direction. If the price had moved 30 pips against you, on a standard lot you'd have lost $300. This is why understanding lot sizes isn't optional, it's fundamental to how you manage risk. And we're going to cover risk management properly in an upcoming video, because getting that right is what separates the traders who last from the ones who blow their accounts in the first month. So let's do a quick recap. A pip is the standard unit of price movement in forex, fourth decimal place for most pairs, second for yen pairs. A pipette or point, depending on the platform, is 1/10 of a pip. The fifth decimal place. A tick is the equivalent concept in other markets like commodities and indices. A unit is the raw amount of base currency you're trading. A lot is a standardized bundle of units. Standard is 100,000, mini is 10,000, micro is 1,000. And your lot size determines exactly how much each pip is worth in real money. Get these concepts locked in now, because everything else we cover on this channel, risk calculation, position sizing, reading your platform, all of it builds on this foundation. Next video we're going to talk about leverage. And if you think pips were an eye-opener, wait until you see how leverage actually works, including the part most people don't want to tell you. I'll see you there.